So for traders, before you start or go into the market, you need to take note of these 5 important points or information. We have the trend, we have the supply and demand, we have key levels, liquidity, and imbalance. So we'll start. I would like to call on our brother Joseph to start with trend. Then Madam Omoumi will do supply and demand. I will take key levels and liquidity, and Mama Comfort will take imbalance. Thank you very much. So over to you, my brother Joseph.
Okay, good morning, Madam. Good morning, my able chairman. I'll just share my screen. Okay, only us can share in this meeting, so I cannot share my screen. No.
Raise your hand, Mr. Joseph, so I can make you co-host. Okay, I think I've seen you. Yeah, I've seen you. Let me make you co-host. All right, you can go ahead now. Your co-host, you can go ahead.
Hello, can you hear me now?
Yes,
hello, can you hear me? Okay, so I'm trying to share my screen. Please, can you see my screen? Hello, can anybody see my screen?
No, please. I can see it.
I click on share screen. Why is it showing?
Master Joseph, are you using Rich Vandigar's chart? Hello, Mr. Joseph. Oh la la.
Sorry, but is there a way we can randomize it? Like anyone of you that is on is good can start.
Okay.
Hello, sorry, the network knocked me out. Can anybody hear me now?
Welcome back, sir.
Okay, sorry, please. Can you still make me an host again? It's knocked me out. It's only the host that can share.
Yeah, raise your hand, sir. Your digital.
My hand is up.
Done.
Okay. Thank you, sir. Can you see my screen? No.
Not loading yet. It's not loading yet, sir.
Click on share screen.
You need to touch the screen you want to share and then share.
Okay, I have done that. And it's wow. Okay, I think I am up now. So is it sharing now?
Yeah, it's up now, sir. You're good.
Yes, it's up now.
Okay. So basically, I will start with the Forex factory. Today is 14th of August. Basically, we will normally come and check to see the impact news. From the information on the 14th, we're expecting impact news around 1:30 today. If you can see, hope you can see that. So let's be careful and as we trade. Thank you. So basically, I'll be talking about trend. So based on Rich Vandiga, he talked about trend, and for trading, it's all about up. There are three basic kind of trend. We have the uptrend, the downtrend, and the consolidation. So basically, the team yesterday when we were having our discussions, we learned that for every price or for every of the trading, it starts from for uptrend, it's from one point to the other, and it's higher height and lower height. So if you see from point A on this upward uptrend, it goes from this first point. If I can get this. So I want to get a pen. So to be showing it that it starts from this point, this first dot. Look at the uptrend. There is a dot, the first dot. So it leads from that point up. It's going to upper high, down to lower height. Then also it all will go to upper. The next one will now be the new higher height. Then we also have the lower height. So that is how the market moves. It moves for the uptrend to go from higher height, lower height, higher height, lower height. That is for the uptrend. Then for the downtrend is from higher low to lower low, higher low to lower low, higher low to lower low. And for consolidation, it just moves within one place, going ups and down. If you see the from the market, our present market, I open my trading view. From the trading view, you can see that the market moves both ups and down, and as far it doesn't break the lower. For if you look at this August, where the 12th, where things starts from, you see that if it goes to higher height. If it doesn't break the lower height, then it's in the uptrend. So, but when it breaks the lower high, then it's either in consolidation or change to the downtrend. So when you are in the market, you should always be observant of the movement of the market, such that if it goes from point A to point B and it's on a higher height, then you see that it's uptrend. Higher height, lower height, higher height, lower height, keep going that up, the other is the uptrend. Then for consolidation, for consolidation, it's like if you look at the 12th of August, you see that there is a consolidation happening within one point. Consolidation happened within 1 point. But when the thing changed, like this morning now, we have gone from, if you see the marking I did at this top, where we have the break of structure from that chip, that is 33.64. It has come down to 33.58, went up and down it went. So now it's showing a downtrend. Now at the moment it's going up. So if it comes down from below that 33.56 to maybe 33.44, then it starts going down the downtrend. So this is what I understand by the trend. So you have upper trend, downward trend, then consolidation. Thank you, and back to you. Did you get that?
Yeah, we got you, sir.
Okay, thank you.
Madam Faustin, who is next, please?
I think it's anti-comfort.
Good morning, ma. Okay.
Chairman, sir, please, you need to make a co-host, sir. An anti-Faustin.
Okay, Mommy Comfort and Anti-Faustin.
Yes, sir.
Okay, don't for Mommy Comfort. Anti-Faustin is not raising her hand, so I can easily spot her. Mommy Comfort, there are two of your devices here. I've made one host, so I don't know which one you're using. Madam Faustin,
The
kindly raise your
one with my hand, sir.
Okay, please,
Okay,
sorry. Okay, I'm here.
Okay, Madam Faustin, I'm looking for you. Okay, just hold on, let me find you.
My hand is up.
Okay, I've seen it.
Okay. My internet went off, so I don't know. Was Mr. Joseph able to join?
Yeah, it's done, ma'am.
Oh, okay. The next is Madam Omoumi.
Good morning, ma. Yeah. Good morning.
Good morning.
My leaders in the house. I want to appreciate you, Chairman, for all you do for us. Mr. Ezekiel, thank you very much. Another, Madam Dupe, Dr. Dupe, Dr. Love, Dr. OJ, I want to appreciate you all. Yes, I want to pick my point from where my colleague stopped. Though I said I'm not at home, right, really, but I love to join every time. Wherever I am, even inside the bus, I will join. But I have to go somewhere to present this morning. I want to talk about demand and supply zone, part of our SMC strategy. So like my colleague said, there is a support and resistance. There is like trend. When we have a trend, we have support, we have resistance. So like I want to talk on the demand and supply. When we identify our support, it will be easy for us to identify our supply zone. And when we identify our resistance also, we can also identify our demand zone. So demand zone is the point where we take a buy trade, and our supply zone is where we take our sell trade. That's what I want us to know. But I cannot, practical aspect we share is not, I don't know, it's not possible for me now, but I will say what I understand about demand and supply. So when we get to support zone at the top, like the top of the chart, when it could not move again upward, then we should be looking at sell to take a sell trade from support zone. We should be looking at to sell to take our sell after our confirmation. So, and when we if it's a downtrend, and when we are talking about demand, that means we are, like my colleague said, that we have higher highs, higher low, higher highs. You will know that is a demand. That means we are buying upward. So cannot move the candlestick cannot move up again, then you know that we are already at the support zone. It cannot break the upper support zone, the major support zone, or any support zone that the trend got to. It cannot break it. We will say that we are taking ourselves from there downward again. So the down part where we take our, if we want to take our buy, that means we target our resistance zone down, resistance zone where our selling point, that's our highest selling point, and it can be our major resistance zone also, because we can have minor zones, we can have minor demand zones, we can have minor supply zone. Our major supply zone can only be violated after it has been broken by a sell trade. But as far as is not violated, it's still valid. So we will take our buy from the resistance zone upward. And to identify our buy zone to move down to resistance, that means we will see that our chart is going lower and lower and lower. Then we know that we are going towards a resistance zone downward. That's our going to our supply zone. So that is what we should always take cognizance of when we are buying and selling, that we have a supply zone and then we have a demand zone. We should identify our demand zones. Sometimes our demand zones can also we can have minor demand zone apart from the major one. So we should always take note of those things. That means we should be using our higher highs and higher low, our break of structure to identify all these. So if I could, assuming I'm around, I'll be able to share my screen, but now I couldn't, please. So that is what I can say about the demand and supply zone. Thank you very much to my able leader, Madam Faustina. Thank you, ma.
Okay, thank you very much. Can I quickly do some correction?
Yes, ma.
You have done so well, but I think you are
Yes.
mixing up the supply area and the demand.
Okay.
So the support is where you take a buying trade,
Buy.
And
trade, yeah. Okay, on
yeah,
Incat.
and then the resistance is where when the market is going up to a point where it's no longer going up again, especially
Going
it
up
depends
again.
on
Yes,
the
I think I
trend.
mentioned that.
Yeah.
Yes, ma. I think I
So
mentioned
you
that.
take
I
our
mentioned that.
selling from the resistance zone.
From the resistance. I think that
Uh-huh.
I mentioned that now. I mentioned
Yeah,
that now.
yes.
Madam
So
Morumi, please just calm down. Let her
Yes.
make the correction. Thank you.
Okay, ma. Okay.
yeah, you
Okay,
said
ma.
it, but in the explanation, because you are not
Okay.
using the chart, it's
Oh,
confusing a
oh.
little bit. So I realize we have to correct it so that our colleagues will not be confused. Currently, I'm sharing Rich Vandigar's SMC and the supply and demand zone. Please, can you all see my screen?
Yes,
Yes,
ma'am.
ma'am.
Okay. So,
Yes, we can
Madam
see.
Omomi, thank you very much. You have done
Yes,
so
ma.
well.
Yes,
Your
ma.
explanation is good.
Thank you, ma.
And I just
Thank
want
you,
to
ma.
add a little bit to it. Now, when we look at the chart, the trend from my left is going down, which is bearish movement. Then on top, we see that there is what? A change of character, sorry, BOS. It started going down, it goes up, and then you can take, here you are not supposed to take a trade. You watch for the, we call it supply zone of a week. Now this week cleared the previous candle. And then started going down. But you shouldn't take a trade. You have to be patient. The market will go back to test where you had the wick or almost at the base of it. And then there you, where the wick is down, you take your trade rather from there all the way down. So you have to watch out for resistance. That is if it's a bearish movement. Now, the opposite is the supply zone or where we can buy. Now, the market went down all the way. And then you see that the buyers started entering the market. So it's no longer selling, it started moving upwards. And it breaks the structure of the sellers. Then you have to now watch it carefully. Sometimes the moment it gets to the demand zone, and then we see that it started buying, then we jump in. It's dangerous. So we have to be patient. Let's see whether the sellers, the buyers will break the structure of the sellers. Now, breaking the structure is just the movement upwards from where it was. It start moving up, then you know that there is what? A break of structure. But to take a trade, well, we can take a small buy, but it's advisable to be patient. By all means, you will see that the market will come back to test the breaker block or where the demand started. It comes back, and that is where you take your trade now up to where you find the resistance zone where they started selling. Then you can take your TP to that level. So in short, you have to mark up the highest market zone and then the lowest market zone. And then you also make sure you find out where the market came down, test it, break the structure, then you know that it's now preparing to what? To go up. But to be advisable, allow it to come back test the demand zone over here, or the supply zone, and then you take your trade. So that is what Rich Van Diga said. Okay. I'm going to take the third one, which is what? Key levels. Key levels. So what are key levels? Okay, in order not to waste time, it said key levels is where price visits and react from repeatedly. Where price visits and react from repeatedly. So when we look at the chart from my left, the base, you see that it touched the first line about 1, 2, 3, 4 times. It moves up, then, so here we can take it to be our support level. It moves up to this level. And then it came to this place also, but the movement keeps coming back to this very key level, and it will bounce back. It comes, it bounces back. Now, people can take short trade or short selling or buying based on the key levels. But you have to be careful also if the market is ranging, that is if it's moving in sideways. If you look at this very one, you see that it has moved sideways in between. So you have to be careful where to buy or sell. If you are buying, or if you are selling from the top over here, it comes all the way to this place, it bounces back. Then it drops down, bounce back to this very key level. So the key level is just where the price reacts repeatedly. So you have to observe it before you take a trade. I hope I'm clear on that. Key level, that is all we can say about it. So when you are observing the market, watch out for where the price visits and reacts. Okay. Now, the last time we talked about liquidity. And one may ask, what is liquidity? They said the market needs continuous balance of buyers and sellers in order for an instrument or trade to trade efficiently. So the market will seek to push price up or down in order to capture liquidity or to capture money. Let me just put it that way. So we have, you see that when you come down here, that is the supply zone where we take a buying trade. You see that sometimes your stop loss is right under the last low. You bring your stop loss there. Now, sometimes the market will come all the way and stretch, not even the whole body, but just a wick, and stretch a long wick to clear your stop loss. And then it start going up. All right. So that is where they get liquidity. And then we also have the bearish liquidity, which is what? Where the sellers also, you get to the top here and you put your stop loss at the top, hoping that there will be no problem. The moment the market gets there, it touches or it breaks and pull down your stop loss and clear you, and then start going down. So we also need to watch out for the external liquidity where the big market players clear our stop losses to make profit and then pull the price down, and then they make money. Now, so that is all about liquidity. Another liquidity is where you have the imbalance. So Mama Comfort will talk about the imbalance. So we have the external. These are the ones that are outside the chart at the low or at the top. when you are buying or selling. So Mama Comfort, can you please take it for the imbalance so that we know there are three major liquidity in the market. The first one is the bullish one, the bearish one, and then the imbalance. Thank you. So I'll stop sharing. Mama Comfort, please take it.
Nancy Comfort, you're muted, ma'am.
I'm going to talk about imbalances in the market and referring to what we call as fair value gap, FVG. Usually in smart money concepts, we have these institutional traders, the big companies, the hedge funds, and so on, because they are the major movers and shakers in the market, and they inform all these manipulations that can cause an imbalance. Now, what really is an imbalance? An imbalance or a fair, a fair value gap is where you find this imbalance. Because what happens is that, for example, as we are looking at this chart here, we can see that we are in a downward trend here. And you can see that we have some candles that are very big compared to the other candles. And when you have a big candle like this, it's a momentum candle, which shows that there was a very big move, selling move down here. And it went so fast that there was no buying activity, so to say, because thereby causing an imbalance. And that is shown by this big candle. So what the market, what the smart people did is that they just allowed this big sell move to move through this area, creating a zone where there was no buying activity. So what we see here is an imbalance. Because even if we look at, if we should refer to even our traditional markets, in any market, there must be buying and selling. So it will be very strange to enter a market, you only have sellers there. No buyers come to the market to come and buy anything. Definitely, there's something wrong with that market. We can easily say that that market is imbalanced or that market is inefficient. Because for a market to be efficient, there must be both the buyers and the sellers. So, but what has happened here is that a manipulation has been done by the big institutional traders and allowed this quick sweep down, is a selling move, a mighty one, without any buying activity even being allowed. And this type of thing is what is called a fair value gap. And it's just mainly characterized by being a big candle between a previous small candle to it, and after it, another small candle that is, yes, and there's a sort of overlapping of these two, of the first candle and the previous candle. So you just, to get the real area of this imbalance is just to mark the end, the tip of the first candle, which has been done here, and the top of the candle after it, which is this, where you have this wick here. So all this middle area is the fair value gap. So, and what do we have in this fair value gap? Are the orders sitting down there. that was caused by that swift move. So the market hates imbalance because the market has to be efficient, so that later on there will be a move whereby to come back and take out those orders sitting in this imbalance. So, and that's what we can see here. We can see that this market is gradually gravitating back, and then to this fair value gap, this area of imbalance later on. There was a little touch here, but the whole FVG will have to be mitigated later by taking out all the others sitting down there. So this is how we treat fair value gaps, which are also referred to as the inefficiency or the imbalances in the market in simple terms. And you can find them in different areas where, because this action happens repeatedly. We can see that even the one we are actually referred to here as our example is a bearish fair value gap, because it happened in this sell move down, this bearish move down. There are also bullish fair value gaps, like the ones we have here where my cursor is. This is a bullish fair value gap. You can see that the market has shifted here and has started moving up in this buy move here. So you can see that even these candles have passed through these fair value gaps, because market will always come back, or price action, so to say, we must always come back to ensure that these fair value gaps are taken, the others sitting there are taken off. So these are where we get our various trading opportunities to trade these fair value gaps. So that is shortly what is a fair value gap in simple terms, saying it in the layman's language. So I think another thing I just want to mention is change of character. Sir? Okay, is the change of character. Change of character occurs when there is a change in nature of the price action. As we see here, we can see that this market is trending down. It's in a bearish move, and until it got to this candle here, this doji candle, showing, which is a trend reversals candle, showing that this selling move is coming to an end, and that is what occurred. And immediately this buy candle came up, the market started moving up, and at this point it cut across and came up. So it's now brought about this change of character. In other words, the market is now buying. So that's what creates a change of character, contrary to break of structure, because break of structure actually is confirming continuation of a trend. For example, we have this little move, selling move down here, then you have this pullback here, and what happened? This sell candle here moved and broke the previous low, still confirming to some point the market is going down. So generally, break of structure confirms the continuation of a move, while change of character implies a change in the trend. So that I just wanted to mention briefly the difference between break of structure and change of character. So I think at this point, I would stop at this point. And I think I've, in very simple terms, explained what a fair value gap is. Thank you.
Thank you very much, Mama Comfort. Excellent. I give you 100%. Because if the pensioners are reading charts like this, the young ones, you have no excuse. Okay, so now we are asking question time.
Mr. Zika, I don't have a question. Can I say something, Mr. Moderator?
Please go ahead, ma.
Yes, thank you. I want to celebrate this group.